All right, hello everybody. So this is a pretty crazy video from the Dave Ramsey show. So can't even make minimum payments, $550,000 in debt.
And what do you do when you can't pay the minimums? That's the bottom line question. My four walls are up and everything else is done, but I just can't get to all of the debts with the minimums.
Mm.
Do I just let them keep calling and just keep answering them until I'll get to them when I can? Do I try to negotiate the minimums? What do I do?
Well, number one, you're doing a great step in just proactively communicating with them and letting them know, hey, here's where I'm at. Here's the bills. Here's the order I'm paying them in. Here's how much I can give you this month. And if you do that, it's better than you ignoring the calls and it going to collections and have people coming after you. I want you calling them more than they call you.
Okay.
So what are these payments? How many do you have?
There are several of them. They total up to $555,778.
$555,000?
Mm-hmm.
Is this all personal debt?
Personal, pretty much personal debt.
Does that include your
there's
mortgage?
No, that does not include our mortgage. And there's some land in there. There's credit cards.
What are the big chunks?
How did you
That's
get
$500,000.
$500,000 into debt, Regina? What happened?
Just a little bit of everything.
It's not even half a million. She's like I think almost a million if you include the mortgage.
You stop paying attention, and you just kind of keep going. You make good money, and you think that you're invincible, and one day you turn around, and that's where you are.
What's your household income?
200.
Okay, and is it just you? Is there a spouse?
Yeah, I have a spouse.
Okay. And how much of this is kind of the consumer debt? Outside of the land, what kind of debt are we talking?
We're still at 4 because the land is only 100.
Okay. So what's the rest of the 4? I'm confused here. Is it student loans, credit cards, car payments?
Student loans, credit cards,
Medical bills,
consumer
personal
debt.
loans?
Yep. Medical bills, personal loans. Yep.
I'm running out of things to even throw out there,
She got
Regina.
everything.
I mean, if you have them, and that's really all. But there's just a lot of
What's the big
them,
big ones? Like how much credit card debt are we talking?
The credit card debt is 50,000. Personal, the consumer loans are probably the biggest ones. Those are in the 150 range.
What was that for?
What did you buy?
Just a whole lot of stuff.
Like stuff for the house? What are we talking? I don't even like if you
Yeah.
gave me $500,000, I don't know that I'd have enough ideas to spend it like that. So I'm just I have a dark curiosity at this point.
Yeah, stuff for the house. Just a lot of stupid stuff.
Okay. So is your husband on the same page that you guys are going to get intense about this and go scorched earth and live like broke people because you are broke people?
No,
He's not on the same page. What does he want to do?
no. File for bankruptcy.
And he's just resigned to go, let's just keep going into debt. It's fine. When we have to go bankrupt, we'll go bankrupt and start over.
Yep.
That's crazy. And you know what? They live in Texas. No state income tax.
Oh, Regina.
Regina, don't do that.
I'm not. Definitely.
Well,
So
we
that's
need
what I'm
both
asking.
parties involved to be on the same page because you can't do this alone.
What do y'all do for a living?
I'm in banking, and he's in IT.
So you know what?
She's a banker and she's a victim of the banking system. That's crazy. I wonder if that 200K of income is like after tax. Because it seems like it. Because she has $500,000 of debt on top of a mortgage. And I don't think people who even make $200,000 a year can even get that much in debt.
Declaring bankruptcy does to marriages,
Oh,
what it does to
absolutely.
individuals like you know.
Absolutely. Hmm.
I mean, your lives are going to be a living hell
Yeah.
for the next decade if you do this.
They're not going to be because we're not filing. That's not going to
Good.
happen.
All right.
I'll tell you what you can do. You're going to sell everything that you can sell, meaning
Everything.
the land is getting sold.
Bye,
the cars
Felicia.
are getting sold.
Bye, Felicia.
The crap that you bought with the credit cards is getting sold.
Goodbye. All of it. All of it.
We're working on it.
So
Put the
if
land
you
up for
sold everything
sale.
you can sell, what would that add up to out of the 555?
If we sold everything that we could, then we're probably say about. Let's see, the land is one.
Cars, sell them. You're Camry people for a
These
while.
are nice cars, I
Really?
imagine.
Yeah. No, we don't.
What's your house worth?
Our house is worth 580.
And what do you owe on that?
4.
Right. So
Okay.
basically 4 plus 5, that's basically almost $1 billion of debt, and that's what I mean is that she has a ton of debt, and I honestly think this is 200 after tax, not 200 before tax. That's just what I feel like, right? IT worker husband, IT workers make a lot. She's a banker. That's a victim of the banking system. So yeah, so you heard it, $555,000 of debt, and you know, there are several ways to pay it off. There's Dave Ramsey, which is the baby steps. But here we'll just talk about velocity banking. So let me pull off a spreadsheet to pay off debt. All right, so I have here a sample scenario of debt, not exactly like what the lady had on TikTok or Dave Ramsey, but if you have $200,000, and I'm assuming it's after tax, because if you combine an IT worker's income and a banker's income, I think that's more than $200,000. Plus, they live in Texas, right? So Texas has no state income tax, even though they have higher property tax. Okay, so I'm just going to assume it's 200,000 divided by 12, which means you have a personal income of 16 grand. And not only that, we're going to have 11 credit cards, an auto loan, and a mortgage at 400,000. And on top of that, personal expenses that equate to about 2,700 a month. Okay, so we're going to pay it off using something called velocity banking. What is velocity banking? It's just a debt payoff strategy where you throw all of your money into debt using something called a line of credit. And we assume that we're going to have the same income, right? Same income. And we also assume that we're going to have the same expenses. And what's really important is that you have to list every single debt that you have and all the payments associated with it, along with your personal expenses that are not tied to debt, right? So food, gas, insurance, things you're always paying for every single month. And so here on this side, we're going to do something crazy that people will freak out about, which is not save money, right? So really velocity banking, if you really want to deconstruct it, is just not saving money and then using a line of credit to help you not save that money, right? The way that you can phrase it is you're using a line of credit to help maintain your cash flow. So I'm going to go ahead and do this, C2 minus C3. And so after making about $16,000 a month and you have $1,200 left over, feeling pretty good about that? Probably not, because you make $16,000 a month and you only have $1,200 left over, right? So we're going to have access to something called a line of credit. So what is a line of credit? Basically a financial tool where you could borrow money, pay it back, and then use it over and over again. So there's personal lines of credit, business lines of credit if you own a business. There's also, what else? A home equity line of credit. So if you own a home and you have equity inside that home, then you can use that equity kind of like as collateral for kind of like a credit card type of instrument, and then just borrow from it and use that money wherever you want. Okay, so now here's the thing: if you make 16 grand a month and you only have $1,200 left over because you have all this debt, this is the same question I got to ask every single time about when is the best time to get debt or a line of credit, right? Do you think the bank will lend you, let's say, a huge line of credit when you're struggling with your cash flow? The answer is no, because banks don't lend money to people who need it. Banks don't lend money to people who need it. So people who need money, according to the bank, are very bad people, right? And the reason why the bank thinks that they're, as an institution, that they are very bad people is because people who need money don't pay you back, right? So just remember that. Now, why do I demonstrate with the free and clear line of credit? It's because I am lazy. And if you don't have a free and clear line of credit, the work becomes so much harder. And so I'm not going to do that, right? But I do have a 99-cent membership where I did do a live stream of a real life case scenario of 22 debts and $4 left over. So if you want to see that, go ahead and join the YouTube channel membership. 99 cents only. Okay. All right. So now let's go ahead and do this. So if you don't know what the cash flow index is, it's just basically a formula of your debt divided by the monthly payment. And what we're going to do is do that for all of our debts, right? And I forgot to do it for here, but hold on one second. Let me go ahead and copy and paste some values. All right, there we go. So now we have these cash flow index numbers, and what do these mean? But basically, think of this as a ranking system. The lower the number, the more bang you get for your buck. And so, why is it this? Why is it for this high number debt you don't want to pay it off? Is because you don't get that much bang for your buck. For example, in order to pay off this mortgage, I literally have to give someone $400,000 to only get $2,300 back in my cash flow. Whereas if I give one fourth of that to this credit card, I get twice the amount of cash flow, right? So more bang for your buck for paying off the debt. And so how much credit card debt do we have? We have 5, 8, 15, 27, 30, 37, 10, 35, 12, 15, 100. And let's count the credit card debt. So that's 265,000. 265,000. So I'm going to cheat a little and pretend like I have a bigger line of credit, like 270, because I'm lazy, at least for this demonstration. But this is what I want you to show any of your friends if they make income and they're struggling with debt. Okay? So let's say all we did was a balance transfer of this debt, 265,000. All we did is a balance transfer, right? So we just move this credit card debt with the low cash flow indexes into the line of credit, and then guess what happens here? Okay, well, because we did essentially a balance transfer, all these payments go to zero. Whoopsie, not, yeah, not that payment. All right, so now let me go ahead and do this. So, because all of these credit card payments went to zero, what happens to your cash flow? Oh my goodness. It literally went from 1,012 or $1,200 to 11 grand, and I didn't even do anything. Okay? So I literally did not do anything except just transfer the debt. And how do we get this line of credit to simply transfer our debt is get it when we don't need money, right? It's the entire paradox of the financial and banking system that banks don't lend money to people who need it. And then the final step is now we're going to not save our money and use our entire paycheck to pay off the debt. The entire 16 grand goes here, expenses come out, and then we rinse and repeat over and over again, right? So after every single month, the debt should go down by 11 grand, and then the interest, right, should be based on the average daily balance multiplied by the interest rate divided by 12. So how do we get the next month's balance? Previous month's balance plus previous month's interest minus our cash flow, so 11,029.4. And then let's go ahead and calculate the interest. Interest is based on the average daily balance multiplied by the interest rate and divide by 12. And then I'm going to go ahead and copy and paste, right? Copy and paste, and let's see how long it takes to pay off that $200,000. So in this scenario, it would be about 27 months, so a little bit less than 3 years, right? So I'm going to go ahead and go back here. So 27 months. For how much was that? That was about 265K, right? 265K, 27 months. And then now I'm going to copy and paste. All right. And so now we have the auto loan and the mortgage. So this should be really easy to pay off. And then I'm going to put in the loan calculator what month it is. So it's month 27. Month 27. Again, use the cash flow index formula. You pay off the smallest CFI cash flow index because it gives you more bang for your buck. So I'm going to move this 17 grand into the line of credit. And I'm just going to go ahead and I'm going to copy and paste into here plus 17054.53. And then it doesn't really actually it gets paid off in 2 months. So now that we move the car debt into the line of credit, we get an extra $500 back in our cash flow. So now it's 11,568. We're about a little bit more than 500. And I'm going to go ahead and copy and paste. And then we're going to do this. Oh, this one's wrong. Hold on, my bad. Yeah, it does get paid off in 1 month. Never mind. Okay. All right. So let me go ahead and do this. So month 28 is going to be 295K. All right, and now we have the 30-year mortgage. So we're going to go ahead and figure out what the balance of the 30-year mortgage is at month 28. And we see that it's we only chipped off about $12,000 in the balance, right? So now at this time we have two options. So the first option is just dump your entire $11,500 of cash flow as an extra payment into the mortgage, right? And that's certainly doable. Or we can just move the mortgage, parts of the mortgage into a line of credit. Now, what is the advantage of either one? The first one is just it's obvious because you're just making extra payment, right? Now, people are afraid to do that because they think, oh, extra payment into a loan means that the loan is gone. And that's not technically true, right? You can always use your credit cards as a backup or whatever. But the reason why it's so hard for people is because once they make that extra payment, then they're going to enter in a territory called segregation of income, right? So segregation of income means that your income comes in and it gets split all over the place. So once you start making those payments or extra payments and then you're splitting your income, then that's how you got to this situation again. So it's kind of a very conceptual idea, right? But what I'm saying is that if you moved part of the loan into line of credit, you can prevent the segregation of income effect. So for example, let's say we move 17,000 in from the loan into the line of credit. How would it look like? Well, it just pretty much look like this. So let me just do this. Let 11568.46. Okay. And then I'm just going to move 17,000. Okay. Hold on. And then I'm going to just do this. Right. So you see that in about 2 months, okay, that 17,000 went away, and then you just rinse and repeat over and over again, right? So it'll be here, and then in about another 2 months, 3 months, actually, I screwed up. Ah. You get the idea. You just pay it off in 1 or 2 months. So now what we're going to do is just use this calculator where just type in the details and then it'll tell us like the number of years it's going to take to pay off and all that other good stuff. So all I got to do here is type in the income. So what's the income? It is 16666.67, 16666.67. And then what is our expenses? So our expenses is about 2,700 a month, 2,700. And then so this one is actually a little bit different from a previous demonstration. 2398.2, 2398.2. And then the original balance is 400,000. And the current balance is, what's the current balance? It's month 28. 388064.08. So 388064.08. Okay. So now, how much do we move into the line of credit? So let's just do 17 grand at 8%. And then bam, mortgage paid off in 2.5 years. Okay. So let me just kind of go here. So I'm going to do 0. And this would be 28 divided by 12 plus 2.5. So that's 4.83 years debt free. All right. So, yeah. That's velocity for you, right? So 2.5 years. Now here's a crazy thing. This is what I want to show. So the most important thing about paying off the mortgage is the order which you do it, right? Because a lot of people are freaking out about like interest rates and all that. But let's say I used a 15% line of credit to pay it off in the simulation. Notice how this goes to 2.6 years and how much did this increase? So if we go back, it only increased 2 grand. So even though we doubled the interest rate, literally went from almost doubled 8 to 15, all it did was just slightly increase that payout time and also increase the amount of, like, very little but relatively the amount of interest that you pay. And then if you do like a 30% credit card, look at that. So we go 37 grand. So it's only 6 grand more even with the 30% credit card, right? So that's why I say the most important thing that you can do when you pay off the mortgage is pay it off last, because the interest rate doesn't affect it as much as you think it does, right? Okay, well, that's it for today, folks. The Korean Atlanta Mentorship. Have a great day, and I'll see you in the next video.